Good evening. I'm Peter Resnicek from ShadowTrader.net, and this is another edition of the ShadowTrader Video Weekly for Sunday, November 21st, 2021. So obviously I'm not speaking to you from the new studio that I have with the big touchscreen TV, etc. I am still a little bit under the weather, quote unquote. I had a little bit of a mishap on my one wheel, as many of you know. Broke my collarbone out here towards the shoulder. Also some cracks in my pelvis and kind of messed up my leg a little bit. But I've been trading full time since I've seen you last. And since I am not able to record a proper video for you in the studio, what I'm presenting to you today is a recording of a live session that I did very recently, this past week, with my subscribers in Weekly Options Advisory. And I've titled this video Options Seminar for a reason. And I hope that when you go through the video and you listen to everything that I was saying and the interactions I was having with my subscribers, I think you'll realize that it really is a full-on options seminar. A lot of what I discuss, these are concepts and tips and tricks and things that I think that a lot of other people like to, package into courses that they want to sell to you for $1,500 or whatever, but I generally don't do that. And this is a really, really valuable information, I believe. So let me tell you just a couple of things that about this video that I'm going to be talking about. The video itself was a recording of a live session in Weekly Options Advisory earlier this week, as I was saying, but it was a very specific type of live session in that I put out an alert to my folks and I said, listen, let's have a couple hours together, hour and a half. I can't remember what long it was. Let's do a webinar together that is geared more towards newer traders and addressing some of the issues that a lot of newer subscribers have, such as margin requirements on ratio spreads, things like that, how to structure trades, things like this. And this became a really valuable conversation, I thought, between all of us about a lot of important concepts. So let me tell you some of the things that you are going to see in this particular video. One of the first discussions is how to properly use alternative structures such as broken wing butterfly, unbalanced butterfly, or even vertical as alternatives to ratio spreads, which, even though they are my favorite, and I do firmly believe that it is a spread that it should be in the repertoire of every active short-term options trader, I do understand that it can be margin intensive and be prohibitive for a lot of traders with smaller accounts. So in this particular video, one of the first things that we discussed is how to use alternatives that'll be a bit less margin intensive. Another part of the discussion was about how to very quickly calculate risk in complex spreads. Those of you who know me know that I'm a huge detractor of the Analyze tab or any of those types of tools when traders use that as a crutch to try to understand what their risk is in any trade. I'm a big believer that everybody who is trading options full-time needs to, at the very least, get their skill level up to a point where they know and understand the risk in complex spread trades immediately just by looking at it very quickly, just by looking at the different strikes and the distance between the strikes, etc. So one of the things in the video is a brief discussion on how to calculate that risk very quickly. There is also a short discussion on Greeks in this video. Not too long, but how Greeks impact the complex spreads as they move and shift with the underlying, mostly focusing on delta and theta, which I believe are the most important. In options trading, there is also a piece on when exactly to exit multi-leg spreads, complex spreads such as butterflies, etc. This is a question that I get pretty often. How do you know when you've maximized all you can get? Should you go for max theoretical value, or should you just get out when you can? So there's an excellent discussion in this video on how to properly manage more complex spreads. During the course of recording the video, which was earlier this week, a live trade actually came up, and it's actually in MRNA, which is interesting because if you recall from earlier videos, I said that MRNA was one of the first losing trades that I've had in a very long time. and I got myself a little bit behind the eight ball in it, but we continue to soldier on. And in this particular video, you'll see some of the live trades that were put on in MRNA earlier this week, all of which benefited greatly from, if you know, the huge gap up in MRNA on Friday. So that's very interesting. There's some live trading as well in the video. There's also some analysis of a Facebook trade that we were already in coming into November 19th that we exited earlier this week. And last but not least, if you're still around for the end of the video, and don't worry, it's not all that long, I condensed about at least an hour and a half or an hour and 45 minutes. I condensed it down into about 45 minutes to make it a little bit easier to digest in this particular weekend video format. But the last part of the video, if hopefully you're still around, the last 10 minutes I thought were the most valuable, because what had happened was a subscriber basically asked me, how do we put it all together? Like, how do you very consistently know how to put on the spreads, when to put on the spreads, and more importantly, how do the spreads move and shift as time goes on, as the underlying moves, as potentially implied volatility moves, et cetera, et cetera? You know, how do you consistently always know when to put these on, how to watch them, how to, you know, sort of let the spread interact with the market and know when to take it off? And the entire discussion really touches a lot upon what I've always felt is that options trading, especially the way that I do it, which I understand may be just a little bit more complex than a lot of people approach the market, is so much more of an art rather than a science. And so that last 10 minutes of the webinar really dealt with seeing it more of an art and than a science, and what you should be looking for when you have complex spreads on as they are being put on and moving closer to expiry as you are managing them. So I hope you enjoy that. So anyway, here it is. I titled it Options Seminar. It's about 45 minutes long in the condensed version. I feel that it's really jam-packed with a lot of incredible information, and I do hope you enjoy it. Okay, the questions can be put right into the options trading questions for Peter, and I'll just go up. There's only a couple here so far, so we'll just start with Lefty CY says, can you talk about the issue of lack of margin for us with smaller accounts, especially on your favorite ticker, Amazon? Okay, so one of the things that Dalton has always, one of the things that I don't know if he says this publicly, but like Dalton and we talk a lot. And one of the problems that he sees on his side of things because we're kind of doing the same thing, right? We trade and we also sell education, so to speak, or ideas. You know, obviously my MO is different from his and whatever, but you know, let's just say that we're kind of contemporaries in the same space. And he has told me many times, he said, you know, I feel like the biggest problem with traders coming into the game is that they are woefully undercapitalized. And this is important to note just so that you understand kind of the arena that we're playing in here. There has been kind of a shift towards more retail trading, which is a great thing, and more sort of low-cost trading, and the ascension of Robinhood, et cetera. All of this stuff has created a world where I believe there are a lot of people speculating with, you know, accounts that are maybe $5,000 or less. And I'm not saying this is a bad thing at all. I mean, this is fine. I think that the playing field needs to be open to as many people as possible, which is a good thing, and it brings a lot more people into the fold for trading and investing. But understand that that's kind of not the lane that I'm in, so to speak. You know, the lane, that's not really the lane that I'm in. Is the, you know, to you know, speculate on crypto, or, you know, let's buy these options for, you know, 30 cents a contract, and, you know, maybe we sell them for $1 or whatever. Those are all things that you can do with a small account, but I look at things in a different manner. And I'm also very, 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 very dependent on what the broad market is doing, et cetera. And that's something also that I notice is very not present very much in a lot of the sort of newer way of looking at things, right? Because it's kind of like that attitude of like, well, what do I need to learn all that shit for when, I can just buy Solana on a Tuesday and sell it on a Friday? Like, what do I give a shit about your market profile or your internals or any of that crap, right? Or what the market is doing or whatever. I'm trading the stocks that are hot, and I'm not knocking that. I'm just trying to make it very clear that if you're coming to me from that mindset, then this might not be the place for you, because you're just not going to get those types of trades, and you're not going to be able to turn your $2,500 account into 5 or 10,000 or whatever. It's just not my wheelhouse. So I'm just keep saying that. Keep that in mind. There are a lot of trades that I do. I can't stress this enough, and I'm so glad that this is the first question that was asked, because I know this is on a lot of people's minds. If you take anything away from what I provide here, I want you just to take away one type of understanding that, or being able to understand, I should say, what type of trade I do, what that means for you. Because you have to understand that if I do a ratio on Amazon, which I understand is prohibitive for a lot of people, you have to be able to look at the price, meaning is it a credit, is it a debit, is it even money, and the width and the time to expiry. And from those things, I want you to be able to figure out a trade on your own that works for you. That's the most important takeaway. Like I've said this many times, the best emails I get, the ones that make me most happiest, are the people who email me and say, I didn't do what you did, but here's what I did, and it was my biggest winner this month. Thank you. And the trade they did is not even close to my trade, but it's in the spirit of it. It's in the right thing. So know if I'm bullish, know if I'm bearish, etc. And I almost don't want to say this, because trust me, I know how it comes off sometimes, but look at my track record, right? I'm very rarely wrong on direction. Not every trade is a winner, but almost never is like, well, he thought it was going up, but it clearly just went the other way. Like MRNA, for instance. Those MRNA instances are very, very rare. So if you come into the advisory at least trusting me on that point, then please understand, you don't need my trade. You don't need my trade. Like Apple is a perfect example of that today. If I'm willing to pay $3 for a vertical that goes all the way out to December, and in your account, the best you can do is maybe, I don't know, buy 50 shares. You should buy 50 shares. You should take that alert and be like, okay, I have a very tiny account. I can't do any of this shit, but I see what he's getting at here. I'm buying 50 shares and I'm holding them until Christmas. Right? Do you see like, that's the essence of the whole thing. You don't need to do what I do. Because it really bugs me when people are like, this is not for me. I can't do this. So keep that in mind. So let's talk a little bit about that, about the way, for instance, that let's start with like the Amazon ratio question. How is that structured or whatever, right? Okay. So very important. If the credit is greater than, say, 30, 40 cents, whatever, it's obviously for credit, okay? And I understand this gets tricky sometimes, because like the current Amazon trade is not a good example, because it's kind of both. Like I'm collecting a fat credit off the beginning. Like the first couple, I think we did 6 units, and the first two trades, the first 4 units were like bigger credits, and then the last one was like nothing. So obviously it could go both ways. But like most of the time, if like Tesla is a good example. Tesla, we did many trades in Tesla where we were putting on 85-cent credit, far out of the money puts. Okay, so obviously the trade is not bearish. I mean, it has a kicker to it that maybe it makes money if the stock falls, But if you see me putting on a ratio, which is really just my way of doing vertical, it's just my way of selling naked. It's the same thing. It's just selling more than you're buying. If you see me doing that, then obviously all I care about is collecting a credit, especially if you look at where the trade is. And this kind of drives me nuts that people ask the question like, well, are you bearish, right? Well, if I'm setting up my spread in Tesla, literally 200 points away from prices now, please don't ask, do you think it's going down there? Like, you know what I'm saying? Like, you have to have at least some sense of how the stock market works and how things work. Like, no, I'm collecting a credit. I'm exploiting the fact that the out of the money options are very pumped up, and I'm just taking them. I'm just selling it. That's all. I don't think it's going down there. Okay. And that brings us to the next point is, okay, so you see the trade and you're like, well, okay, well, that's $87,000 worth of margin. I'm not doing that. But okay, right? Then you just adjust that, right? So that's why I always, when I give the alternative trade, I would say that, okay, if that doesn't work, that means that you have to take on a little more risk and you have to have whatever structure I'm doing be tighter. So let's just look at that, for example. Okay, let's take a look at that, for example. And notice on the Lucid here, I'm glad that this popped up. I'm not very big in stuff like this. I don't trade this stock. I have no idea what's going to happen. I wouldn't do 25 contracts or 100 contracts on this, 50, whatever. I don't know. I mean, it's a good trade, but it's unofficial. And I'm just saying. But let's look at Tesla, for example. Tesla's a perfect example for how this stuff works. Okay, so we know, look at how rich these puts are here. They're very rich to me. Like, I don't think the stock's going there. I don't think the market is pricing it properly. It doesn't matter. But here's the 900 that we were looking at, right? So right off the bat, first thing I want to be is at least 50 wide, because I want to capture some movement if it goes there, and I want to be as safe as possible. First thing is, I can't do that. It's a debit. It's not working. So obviously the puts aren't as rich as they were, but obviously the stock has rallied. Let's actually bring this a bit higher, because the example won't work well at 900. Let's see how the example works at 950. Oops, I did that backwards. 5,000. Okay, that doesn't really work either. So again, this is just for example. I'm just trying to show an example of how this would work. But let's say, okay, so we can go like this. We can go 980. No, that doesn't work. Okay, so let's just say this is my trade. All right, so let's say that this is my trade. And you would say, okay, too much margin. So first things first, for the newer traders, remember that if this is the short strike, then my thought process is that this area is safe. On any ratio spread, whatever is the short strike, you should immediately translate that into, that's where he thinks the turning point in the chart is. That's resistance or that's support. Correct? Makes sense, right? That's it. All right, that's what you got to be thinking. And I've said this before, and it bears repeating. Just from the short strike of any complex spread that I do, not just ratio, could be butterfly, could be broken wing, could be unbalanced. Just from the short strike, you have a huge amount of information as to what I think is going to happen, right? Huge amount of information, right? I always structure, no matter what, I always look at that as the mid strike. Like, why is 65 the short in Lucid? Same exact thing. LCID, what's the high in LCID? You see my point? It's the same thing. So you always want to structure that midpoint there. Okay, that's important. So let's say that this is not for you. So you have to be tighter. So first, let's try this. Now, verticals are tricky, but they're not bad. But here, right off the bat, is a pretty good one. $10 risk as opposed to unlimited risk, and you collect 75 cents instead of $1.72. To be honest with you, right? And the risk, is the risk starts at the same point. This is a fantastic credit. It really is. You don't often get 70 cents for $10. If you annualize that, you're making like 1,000,000% a year on your account. If you put your whole account, not that you would do such a thing. I'm just saying that if you annualize this of the return of 70 cents for every $10 risk, and it's capped off risk, you'd be killing it. If you see me do the top part, and you're like, okay, I can't do that. Where does he think the stock's not going, or where should I put my risk? You pull up the vertical first. And it doesn't matter that officially, and in my account and everybody else is getting $1.67, and you have a smaller account and you're getting 70. So what? Who cares? We're not, measuring credits against each other that way. That means nothing. Now, if you looked at this vertical and it was 15 cents, well, that's a stupid trade. That doesn't make sense. So understand, you want to be collecting at least, I can't really put it into percentage terms. For me, it's kind of more of a feel just because I've been looking at this stuff for a while. But, you kind of know after a while what you would sell for and what you wouldn't, what's worth your while. Okay. So that's a perfect example right there, is what you should be doing if you can't do this. The point is to be in the spirit of the trade and be doing it the same way. Not the same way, but you know what I'm saying? In the same spirit of it, meaning, where do I think the risk is? Okay, the risk is at 950. It's not going below there. That should be safe. Okay, what can I do? So let's look at another example now. What is the broken wing trade like? What does the broken wing look like? Ooh, what is that? I don't even know what that is. What the heck is that? Combo? No, I don't want that. Let's buy a butterfly. So obviously we have to take the 940 and push it down and see where it gets us credit. Okay, so that's a pretty fat credit, but understand this. Now again, small accounts. And I love talking about this stuff this way because it just makes so much sense to me. Don't use the Analyze tab. What is your risk here? Look, plus 10, minus 30, equals minus 20, $2,000 a contract, done. That's how you need to look at this stuff. So you immediately, I put out this trade, you either do this or you look at this and you say, okay, what can I do here? I have a much smaller account. I only have $30,000. Okay. I want to be able to put on a few of Peter's trades. So this is $2,000 margin for each one. Okay. How should I look at this? Maybe I'll do 2. Okay, great. That's fantastic. If you collected $225 in 2 weeks on that amount of risk, on 4K risk, again, annualize that. Annualize that. On that 4K, you'd be killing it. That's how you have to think. So what would that be? $220. $220, right? And what if you rinse repeated that every single week, right? Times 52 weeks a year. See? Divided by the, 4,000 risk. See? So that's another example of how you would do it. And then you can, of course, take on more risk. You can be, okay, you can say, okay, well, I want to really go for the gusto. What's the unbalanced looking like? Well, look at that. That trades for a credit with even strikes, even though this is, $10 of risk to the downside, but maybe that's the best play. Don't you think? Because what's your risk here? And again, same thing, no Analyze tab. And here's the other thing. When you guys pull up this stuff and you go to the Analyze tab, don't think I don't know. I know. I know you're doing it. I can feel it. I know you're doing it. I know you're going to that Analyze tab behind my back. So just don't do it. So again, what is it here? Plus 10. And you got 2 of these. So it's minus 20 equals minus 10 equals $1,000 per contract risk. Done. So which of these trades is the best one? I would say this one. Collect 52 cents on every 1,000 of risk. I think do this one. And do you see how you have 3 excellent examples of how very quickly all you had to know was, okay, which strike does he think the risk is at? Okay, he thinks 950, done. What are my options? Okay, boom, boom, boom. So you don't need to sit these trades out just because you see this and you're like, oh my God, $87,000 a contract. What is he, crazy? Who can do this stuff? This is insane. I quit. No, that's ridiculous. You're missing it. You're missing it. It's all right here. And again, like I was saying, if you look at how lucrative this is over time, when you rinse repeat these trades, even just on a couple of contracts, right? If you collected, this is 50 cents for each one. So you did two lots, because let's say you have a very small account. Let's say you only have $10,000. Okay, so you're risking 2,000. You're putting 1/5 of your account into this, and you're making $100 in 5 days. That's actually good. That's actually good. I understand that it's not the, let's put it into Dogecoin and double it type trade. Like I said, if that's where your head is at, then maybe I'm not the guy for you. But to a real trader investor who understands, how to, grow your account, etc. Yeah, $100 on $2,000 in 5 days is freaking awesome. That should be your MO if you want to grow a small account, to be looking for these sort of safe credit trades that are out of the money, with the kicker that you've got a long in front of your shorts, et cetera, et cetera. That's how you do it. You don't YOLO into cheap options. You don't be like, all right, I got 10 grand. I'm going to put 5 on this, whatever, XYZ, and we're going to triple our money. This is not the way to do it. That's the road to ruin. That's the way to take the $5,000 account down to $1,000 real fast. Ted from Philly says, why would you not do a Tesla 950, 940 for a 350 credit? Okay, this is a fantastic question. So I'm kind of going sequentially in these questions. So Ted, you could do that, but understand that when you do that, that is literally no different than selling the 940 naked. You're not going to get, if the stock was to crash, you're not protecting yourself at all. And what I'm trying to teach here is that I'm trying to show you, and you see it on the screen right here, many ways of selling credit that are going to act better for you when the stock goes towards your short strikes. Do you understand that this structure here, BWB, because you have this kicker of the 920 long and 10 long here and 30 short here, this is not going to blow up in your face the same way that a naked put would. And this is also very important to note. Remember, if you have a small account, it's very important for you to trade this way with these ones here that I circled, because what can happen if you have a very small account, by the way, those are Facebook puts bought for 4 cents, which we might just close officially at 4 cents because we made a lot of money on that trade. If you have a small account, you need to understand this, because if you were to sell a put naked, the broker is going to get you out of that at a horrible price, because the broker doesn't want your account to go to zero or negative, and then you're going to lose your whole account. And you're also not going to sleep very well at night. Whereas if you did this spread, the 77 cents, okay, maybe it blows up to $1.50 against you. But again, your risk is capped, so you shouldn't be worried about that. You should just be like, you know what? We're just going to wait this out. I know what my risk is. I went into it knowing that it was $2,000 a contract or $1,000 a contract, right? And that's what I'm doing. That's all. I know what my risk is. I don't need the analyze tab. I'm a shadow trader, baby, right? I know what my risk is. I know that if I don't know, Elon Musk does something crazy and the stock goes to 800 tomorrow, okay, I'm losing $1,000 per contract, right? Because I'm going to make $10 on this one and I'm going to lose 20 on this one because I got 2 here, right? Equals minus 1,000. And I got $60 to do it. So I'm going to lose $940 for every one of these that I put on. End of story, right? You go into it. That's the way you got to be thinking about it when you go into it like that, okay? So it's a good question, Ted, but it's important to understand. Mary Ellen says, should we consider position delta on our own variations of the trade? Yes, Mary Ellen. However, and this is also a fantastic question. However, understand that when you create a structure that is much tighter than my structure, more narrow, okay, understand that the Greeks have less and less impact. Think of it like a butterfly, a tight butterfly, like an even one. Like SPX is a perfect example. SPX strikes are $5 wide, and you put on a $5 wide butterfly, right? Which is like one of the tightest, cheapest things you can do in the market. That would probably cost you 20 to 25 cents, and good luck making money with that. Greeks will have absolutely zero impact on that trade, zero, because all of the Greeks will be canceling themselves out because the spreads, everything is so narrow. So it's the same exact thing with every other trade. Now, obviously with a BWB or an unbalanced, there's a little bit more Greek action because there's a little bit more width, or you've got the 3 short in the middle. I understand. So yes, but in general, just think about that. The wider you are, the more Greeks matter. Just like if you were in, for instance, a single call, the Greeks matter a ton if you're in a single naked call, right? It's very, very sensitive. As soon as you start to spread it and you start to add more complexity into the spread, it matters less. Okay, so that's good to know. But excellent question, Mary Ellen. Excellent question. Let's see here. KD says, do you recommend we make our first long strikes as wide as you do in the ratio and then widen the third strike as appropriate to get the credit? I know there is danger in having narrow with unbalanced flies. Yes, KD, if you have the margin, then the thing that is always going to be closest to my ratio spread trade will always be if you can take this structure here. If you can take this and just add an out of the money put to it. So if you could go 980, 950 and then buy the 700 put or something for like a couple cents or whatever the case is, that's always the closest to my trade. But as I've showed you in these other examples, you don't need to take on that much risk. You're just making a little bit less credit. But yes, you are correct. Bill Zaksky says, I'm not new to trading or to options. Your method is certainly different from the crowd teaching trading. My biggest obstacle has always been when to exit a trade with options. How do you know when to bail out? Stocks, not so much by placing hard stops. Okay, excellent question. So why don't let's think, I don't know, it's hard sometimes to put some things into words. Apple really took off, right? Our timing was good there. Very, very good. Our timing was good. Remember, trade location and timing is 99% of the whole game. And you know what's going to happen with this stock? What really sucks about this is it's going to run much harder and much faster than we thought. And then we're just going to close this vertical for, not that much money. And we're just going to reposition ourselves with a new trade. That's just going to be the way it's going to go down, I think, because it's obvious we could see the 157, relatively quickly. We just took off. But Bill, keep it all about the charts. This is very important. Remember, Bill's question says, my biggest obstacle is when to exit a trade with options. Let the chart tell you that. And many times, and this is very important, like think about Boeing and Facebook, what we did in Boeing and what we did in Facebook. I think that your disconnect, Bill, and I'm not trying to put words in your mouth, but a lot of traders do this. Your disconnect may be that you have a problem with closing your trade at an amount that is far less than its max value. And I don't think that's a good way to think about these things. I think you have to be thinking in terms of what you paid and what you're selling for, and the fact that you are using this vehicle of options to make a profit, and what the max value, the theoretical value of your spread at full value is or isn't, is meaningless. Who cares about that? Think about it more like as if you were buying stock. Like this morning, we could have bought shares in Apple, but we bought a vertical. And we're going out to December, which is probably too far, but whatever. That's the way I wanted to structure it. And we're probably not going to get anywhere near max value. But we bought something for 3, and we're probably going to sell it for 5 within a few days. And that's a home run. That's all there is to think about. Don't overthink it. Don't overthink it. You bought something for 3, you sold it for 5. That's it. Like, I get it that it could be worth more. Or your question is, well, what about the time value? Should we wait? I guess, but that stuff only comes into play when the time is very short. That's when we try to wait it out the most, because if you're not leveraging theta, and in Apple, for instance, with a December expiry, we're not leveraging any theta. Trust me, there's no waiting it out. There's no, could we get more? You know what I'm saying? It's just like, okay, if the stock goes to 157 and it looks like it's going to keep going, we'll wait it out a few more days and see if we can get deep in the money. But we're not going to, we're not going to wait until December and let that thing turn into nothing if the stock falls. So the main thing, Bill, you want to understand is, when are you leveraging time and when are you not leveraging time? So if you come down to that sweet spot that I like so much, like 5 days, 4 days, 3 days to expiry, you'll notice a lot of times I'll put on a trade just a couple days until expiry. That's when you are leveraging time, like a 132 trade, an unbalanced trade going into an expiry just a few days away. Your goal is to hold that as long as possible, right? Some trades that are ratio that we've done on Amazon with just a few days to expiry. And we, that one huge trade we had where we pushed, a 13-cent debit into a $30 credit, right? 13 cents to $30. That is the power of time. That's time doing that. Time is working its magic. Direction too, but it's time. So just remember that, Bill. I think that's very, very important. All right. Somebody just said that MRNA is on the run. So let me just take a quick break here. Yep. Okay. I guess we got to get busy again. All righty. So here we go again. Like MC Light, right? Hot damn ho, here we go again. All right, so we know that this open here, this open is 246. So I would at least want to see the open of this bar crossed, because the open of this big bar, I'll make it bigger. See the open of this bar? That's important to me. If we can get over the open of that, I'd be interested. So we know that open is 246. So probably the next alert we have to send here is like $245.75 at least, just so we know. All right. And then what are we going to do with this? Well, we're going to either target this gap fill with a ratio or something, or we're going to go all the way for this gap fill, which would be the 330. I don't think so. We have this congestion area here at 300. I don't know yet what we're going to do, but we're going to do probably the same thing we've been doing. Now, the other way to look at this too is, if you think the stock is finally perking up, it may be worth actually owning some shares here, but with a tight stop. The problem with MRNA is you could easily break out, and then the next day the stock could be at 233. So, that's why, this is why on the upside, this is not a situation or a stock where I would ever do something like with Apple, where I would commit to a debit. I think the stock's a piece of crap. I think everybody's hating on it now. Could there be some short covering? Yes. But, look at the action here. It threatens to go in the gap. It falls here at Does it go above it here? 245.92, 246.10. So it almost does here, false break, you know, then it goes lower to the midpoint. Now in this case, check this out. Because we only went halfway here, and we're here, and we know we've got trend line here. You know, look at the 200s here. That's not bad. I mean, at 36 to 64, maybe we get 50 cents there, and then we could spend that on doing the ratio here as a debit. So I would still probably look at the same trade. Yeah, $1.14. You know, I'd rather put it on like this as a debit. I wouldn't go, it doesn't make sense to try to make it free. And you know, 270 would blow up big, because the reason I'm picking 270 is, look, 270 fills the first gap is up to 277. What's this low? 278. So if we just filled the first gap, that would be massive. And then look, you've got your 20 MA here at the 300. And then, you know, you're at the money is, let's say it's $7 now. So 3 times 7 is 21, and you've got 30 here. Does that make sense? So that's not bad. That's not bad at all. I think this is our trade. And then I think also that these 200s need to be sold. I wonder if we can get like 50 cents for them in the middle. I doubt it. Maybe 45. Maybe it makes sense that we sell that the puts get sold now, right? I mean, stock's obviously kind of turning in the other direction now, and we'd be below trend here, right? Here's classic trend right here, and there it is right there. So maybe that makes sense to do that sooner rather than later, just the put side, and then we wait for the break on the 246 and do the call side. Because remember, you want to do the call side later because you want the stock to be up to put more credit into those, put more credit into the upper strikes. So that would make sense. And let's just look at these MRNAs here. Let's try this here. I wonder if 45 will fill. Oh, good, 48. Okay, good. So let's do the put part of this now. Let's do the put part of this now. Let's do this right now. Let's do 6 right here. All right, let's do that now, because see how we're pulling back, and now we're catching support. And we don't want to wait until it breaks out, but we can wait till it breaks out for this part of the trade. Note, actually, this went down to an 83-cent debit, which is not bad. It actually fell. That's interesting. I would have thought with the 1.3 it would be more expensive as it went away, but it's not. So we know that we have, what do we get, 48? So we got $300 credit. So we could probably be in 4 of these, which would cost us $320, right? That's not bad. Let's see if we can fill that. Let's see if we can do official size on just 4 of those. See if that's working. And here again, I have to add a little DB, right? Notice the negative number when this comes out. It's a 1.3. And notice here, right? It's a negative on the 80 cents. So it has to be selling at a debit, and I put the little DB, which Toss doesn't do. I add that myself, and I put it in there. And obviously, we're not getting filled on this, so we're just putting it out as a debit. Okay. Well, I mean, we're putting it out as a limit order. Okay. Look at that. Oh, there's our alert. Good thing we sold the puts. I don't think we're going to get this very cheap. I think we got to go to $1 here and see if we fill it $1. Yeah, we got to go to that. Oops. I have a sling on. It's hard to type here. Okay. So we paid 98 cents instead for it. All right, let's go back to some of these other questions. I need to wrap it up shortly, but let's end on these two questions here, which is, Peter, I would much appreciate your discussing how weekly options trades move into profitability over the short hold period. For example, sharing how you understand stock price, IV, theta, delta, and gamma interacting to bring about profit in a butterfly or BWB. How does profit happen as time to expiry disappears? And then this next question, which is very similar, the other person says, how do the spreads move per day, per price change? How do you get that feel? I mean, the dynamic aspect of it. So this is where the whole art versus science discussion comes into play, is understand that I started trading options from a complex sort of standpoint. When it was taught to me around the year 2000, which is the first time I ever was introduced to options, it was taught to me by some folks who were into this sort of very complex way of doing things. And they were doing a lot of broken wing butterfly and things like that. And also kind of, I was involved in a strategy for a while where I was like overlaying butterflies on top of other butterflies to sort of bring a positive delta situation closer and closer to the money and all sorts of stuff. So for me, it kind of happened this way just naturally. And I kind of understood from a early point of how to look at things in terms of, it just made sense to me that the first time it was explained to me, that person also gave me a Word document that had, because at this time I was only dealing in SPX options. The person gave me a Word document that had it had like 100 strikes or 50 strikes in the S&P in the middle of the piece of paper, printed from top to bottom. And that was it. That's exactly what I've been talking about all the time, about saying, just write down the strikes on paper. And I literally started doing exactly what I tell you guys to do right now. And I didn't understand it at first. So I just said, okay, +1, -2, +1. I wrote it on the left-hand side for calls. Then I went to the right side of the numbers for puts. I went +1, -2, +1. And then I said, okay, what if I put another butterfly on top of this one? Okay, +1 -1 equals 0. -2 +1 equals 1. +1. You see what I'm saying? That's it. That's it. Just just start doing that. And then that'll make a lot more sense. Okay. So that whole dynamic aspect of it comes from that. Comes from having the trade on, watching the trade closely, in the, as the price moves and shifts. One of the best things I think you can do, honestly, is have stuff up here, in here. Like, look at this. I put this out at $1.60 so I can watch it. So I can easily just take a quick look and say, oh, okay, is this going to get to $1.60, like $1 more than we paid or whatever? I can just watch it. Put it up here as some sort of a price so you can watch it. Like, here's the NDX butterfly. I put a 250 price. I just pick a price. I just put it up there, see if it fills, whatever. That's all. That's it. This apple didn't fill. I was looking for more of these. I'm gonna have to figure out something else here. So you put it like that, and that helps. But to speak to like some of the things that this person said regarding like IV, theta, delta, gamma, stock price interacting to bring about profit, don't get too hung up on any one of those. That would be a good tip, I would say. You want to kind of look at this situation as like all of those things working in concert equal the price of the spread. And know which of those things you should be paying most attention to. So IV, for instance, will matter a lot more when the trade goes on, right, rather than when it comes off. Because when it comes off, right, we know that everything's kind of crunching down to its theoretical value, and it doesn't matter as much. But you want to obviously try to enter more complex spreads in times of higher implied volatility, or stocks that generally just have high implied volatility, like Tesla, for instance. Tesla is a good example of that. It has high implied volatility, so you want to use that to your favor. But again, understand that all these things work in concert. And as it gets closer and closer, really the theta and the delta are the most important. If you can just master what those two are doing, understand the theta and the delta, and understand when the theta is really working for you or against you, and when, at what point when you have a complex spread, when that delta flips from negative to positive and starts working for you, that's the sweet spot in the complex spread. When you're targeting something on the call side, for instance, when that delta flips from negative to positive, right? Because think about it, the delta starts out negative because you put it on for a credit. That's just the simple way of how things work. You're not going to be able to put it on for a credit and have positive delta rather, excuse me, right? It has to be negative delta because you're getting paid to take on the risk of negative delta, that if the stock goes up, you're going to get hurt. You get paid to take on risk. But the theta, on the other hand, should be positive at that point. Well, that's another thing you want to watch for, is when that theta number starts to get really low, where basically there starts to be a trade-off between, okay, how much risk am I incurring holding on to this versus what I'm getting for it? That's when you know you should be bailing out, kind of, because if you, like, a perfect example, Facebook, our Facebook trade, perfect example. The 350s, the 350 calls went down to under $1 today. So and that's why I sold out of the rest of this. I'm not holding any more of these call butterflies. You can see I sold them all. You see here, when this starts to go below $1, so basically what's happening is, and this is the perfect example of this, is that it didn't make sense at that point to hold on for the 335, 350 to get more, to be higher in price for us, because if the stock falls, I'm going to start losing more money on my 335 than I'm gaining from how much my 350s are losing. You see what I'm saying? There's that trade off right there. And that's the thing you want to be thinking about. So that's why, to me, it was the perfect exit today. And what I said in the alert, to me, was exactly what needed to be said. This could go either way over the next 2 days. I'm not willing to give up a $6 credit in order to see if my $6 credit could go to $8 or $10, when I know there's a very good chance that if the stock is down tomorrow, my $6 credit is going to $4. That's too much to give up, to gamble. You know what I'm saying? Only gamble when it makes sense to gamble, when the odds are in your favor. 50-50 is not odds in your favor. 50-50 is just like whatever, red and black in roulette. It's not good enough. You're going to lose. Because you know why you're going to lose? Because you're going to pick and choose. You're going to pick and choose, and you're going to do it one time and not do it the other time, and this and that. So to me, when I see that the market is moving to the upside and Facebook is down like $1.30 right now, it's the right thing to do. It's the right thing to do. Okay. All right. So again, these two questions, it's really more of an art than a science, but it's something that takes time, and you will understand it better over time if you put your trades on and then put them on the monitor tab like I was showing. Put it at a price that you know is not going to fill, and then that way, at a glance, very easily, when you see, like, let's say it's Facebook and you have a butterfly on, and the max value is $15, and then you whether you were at your desk all day or not, it doesn't matter. But let's just say you came to your desk out of the blue because you were out in the morning, and Facebook was up $5. Okay, that's market generated information that you need to know. How much has my butterfly changed? That's huge information for you to know, because it's relative to your butterfly, which is what's important. And that tells you a lot as well, because let's say your butterfly is too narrow and Facebook's up $5, but your butterfly went up 25 cents. Okay. Well, what is that telling you? I'm in the wrong spread. I'm in the wrong spread. This is not the play for me because it's not helping me. So it's things like that, I think, that can be helpful. Okay. All right. I'm going to leave it there because I'm getting a little bit hoarse and it's time for lunch.